Now let's look at question number 4 of TYK again. A company has purchased an asset at rupees 1 lakh. All right, there's a company which has purchased this asset at rupees 1 lakh. The estimated useful life of the asset is 5 years and the depreciation rate is 20% SLM. All right, so 5 years useful life translates into a depreciation of 20% on a straight line basis. The depreciation rate for tax purposes is 25% SLM. All right, obviously, generally tax has WDV basis, but over here they've actually said that the depreciation will be 25% SLM. In other words, for tax purposes, the useful life is actually 4 years. The useful life is actually 4 years. The operating profit is rupees 1 lakh for all the 5 years. All right. So every year they're actually saying that we are actually going to earn an operating profit of 1 lakh rupees for the next 5 years. The tax rate is 30% for the next 5 years. The question is calculate the book value as per financial and tax purposes and then calculate the deferred tax liability. All right, so let's actually start. And remember, we are now not doing the calculation only for year one. We are going to basically do the calculation from year one to year five. We are going to do the calculation for 5 years. We'll calculate and see how the DTA or DTL moves for every year from year one to year five. All right. Now over here, what I'm actually doing is because I need to do the same steps of step 1 to step 5 every year, I'm actually plotting years in columns. All right. So I'm plotting year 1, year 2, year 3, year 4, and year 5. I'm plotting years in columns so that I'm actually able to do the same steps every year. All right. So let's start with step number 1. Step number 1 is calculating the carrying amount of the asset. Calculating the carrying amount of the asset. Remember, the asset is purchased at 1 lakh. All right. Assume that the asset is purchased at 1 lakh at the beginning of year 1. Every year, I'm going to charge a depreciation of 20,000 because the question mentioned that the depreciation rate is 20% SLM. All right. So at the end of year 1, I would have charged the depreciation of 20,000. Therefore, my carrying amount is going to be 80,000. My carrying amount is going to be 80,000. 1 lakh was the cost. 20,000 of depreciation has been charged, and therefore I'm going to have a carrying amount of 80,000. Second step is calculating the tax base. Tax base is going to be the amount at which it would be reflected in the tax balance sheet. Now, if you think of it, I actually charged a depreciation for the first year of 25%. As per tax laws, I charged the depreciation of 25% in the first year. So the amount of depreciation in the first year that I would have is 25,000 for tax purposes, which means that in my tax books of accounts, this asset would actually have a carrying amount of would have a value of 75,000. If I would have prepared a tax balance sheet at the end of first year, this asset would have had a value of 75,000. Why? Because I purchased it at 1 lakh, I charged the depreciation of 25,000 as per tax purposes. So my tax balance sheet would have a value of 75,000 for the first year. The third step is calculating the temporary difference. All right, calculating the temporary difference. Temporary difference over here will be 5,000 rupees. Under the third step itself, I'm also plotting something called as nature of temporary difference. Nature of temporary difference means, is it going to be a taxable temporary difference or is it going to be a deductible temporary difference? How are we arriving at it? Carrying amount means my future taxable income. Tax base means my future deduction. How is it the future deduction? Out of the 1 lakh cost, 25,000 is already allowed as a deduction. So the remaining 75,000 will be allowed as a depreciation deduction in future. Therefore, 80,000 minus 75,000, 5,000 represents my net future taxable profit. All right, it's my net future taxable profit. Therefore, the temporary difference nature is taxable temporary difference. All right, so I am going to have a net taxable income of 5,000 in future. Therefore, the nature of temporary difference is a taxable temporary difference. The next step is calculating DTA or DTL. All right, we're going to calculate DTA or DTL. Now over here, the tax rate is given as 30 percentage. The tax rate is given as 30 percentage, which means that I am actually going to have 5,000 multiplied by 30 percentage. I will have a DTL of 1,500. DTL of 1,500. 1500 is what I'm actually going to have. All right, so I have a DTL of 1500. Step 5 is irrelevant for year 1. Change in DTA DTL will actually be the same. All right, the change is basically going to be 1500 itself. So the journal entry for year 1 will be deferred tax expense debit to deferred tax liability of 1500. It's going to be deferred tax expense debit of 1500 to deferred tax liability of 1500. That is with regards to year 1 calculation. That is with regards to year 1 calculation. Let's move on to year 2. The carrying amount. Remember, each year in accounting, we are going to have a 20% SLM. All right. In accounting, it's basically 20% depreciation every year. All right. And 20% is on a straight line basis. So every year, my depreciation is actually going to be equal to 20,000 rupees. All right. So 80,000 will then get depreciated by 20,000, and I will have a balance of 60,000 for year 2. I'm going to have a carrying amount of 60,000 at the end of year 2, because for year 2 also I will have charged a depreciation of 20,000. Can I actually plot the carrying amount for all the 5 years? So for year 3 it will actually be 40,000, year 4 it will be 20,000, and last year it will become 0. Once I use the asset for all the 5 years, my carrying amount will actually be fully equal to 0. All right, the question did not mention any salvage value, so the carrying amount is going down to 0. Every year I'm charging an equal depreciation of 20% of the cost, which is equal to 20,000. Tax base has a depreciation of 25% every year on a straight line basis. All right, over here also it mentioned that it's going to be on a straight line basis. So every year I'm going to have a depreciation of 25,000. So for year 2 also I will have a depreciation of 25,000, which means that in my tax balance sheet the amount of 75,000 will come down by 25,000. So it will come down to 50,000. All right, if I actually prepare my tax balance sheet in the second year also I have a depreciation of 25,000, so my 75,000 of asset will come down to 50,000. In year 3 it will actually come down to 25,000, and in year 4 it will come down to 0. Why is it coming down to 0 in year 4? Because as per tax laws, this asset had a useful life of only 4 years. This asset had a useful life of only 4 years. Therefore, the amount at which I was showing this asset in the tax balance sheet is coming down to 0 at the end of year 4 itself. It's coming down to 0 at the end of year 4 because I was charging an accelerated depreciation. I was charging a higher depreciation in tax books. Therefore, the asset came down to 0 before it came down to 0 in the accounting books. It came down to 0 in tax books earlier than accounting books. Obviously, if the asset has 0 value in fourth year, it's also going to have a 0 value in the tax balance sheet in the fifth year as well. All right, once the asset comes down to 0, there's going to be no depreciation, and therefore in year 5 also I have a 0 value. Let's actually calculate the temporary difference for year 2. The temporary difference for year 2 is 10,000. All right, so it's going to be 10,000. So as at the end of year 2, I am actually of the belief that I will have future taxable sales or future taxable income of 60,000. Against that, I'm going to have a future tax deduction of 50,000. Therefore, my net future taxable profit is 10,000. Therefore, the nature of temporary difference over here is also a taxable temporary difference. It's a taxable temporary difference. So because it's a taxable temporary difference, I am going to have a DTL of 3,000. Why? How did I get 3,000? It's going to be 10,000 multiplied by 30 percentage, which is equal to DTL of 3,000. Now, if you think of it, at the end of year 1, I had a DTL of 1500. At the end of year 2, in my books, I want a DTL of 3000. I already have a DTL of 1500. I now want to increase it to 3000. So I have to increase it by 1500. So my change in DTL is again 1500. I want to increase my DTL by 1500. I want to increase it from 1500 to 3000, which means I need to increase it by 1500. Therefore, my change in DTL will actually be equal to 1500. So the journal entry for year 2 is also going to be deferred tax expense debit of 1500, credit deferred tax liability of 1500. As at the end of year 2, if I prepare my balance sheet, the deferred tax liability on my balance sheet will actually be equal to 3000 rupees. The deferred tax liability will actually be equal to 3000 rupees on my balance sheet. Let's now move on to year 3. The temporary difference has now actually increased to 15,000. I'm going to have a future taxable income in the form of sales of 40,000, future deduction of 25,000. Therefore, my temporary difference is 15,000, which is basically going to result in a future taxable profit. This 15,000 is basically the future taxable profit, and therefore, this is also going to be classified as a taxable temporary difference. All right, this is also going to be a taxable temporary difference, and we are now I'm going to have a deferred tax liability of 4,500. I'm going to have a deferred tax liability of 4,500. Now over here, if you think of it, in my books of accounts, I already have a liability of 3,000. I already have a liability in my books of accounts of 3,000 because at the end of year two, I brought my deferred tax liability to 3,000 value. I now want to increase it further to 4,500, which means I need to now again increase it to increase it by 1,500. Therefore, my change in detail is going to be 1,500. I want to increase it. I want to increase it again by 1,500, and therefore I am actually going to record the same journal entry in the third year also, which is deferred tax expense account debit of 1,500, credit deferred tax liability of 1,500. All right, so if in my balance sheet at the end of year three, I will be showing a deferred tax liability of 4,500. I will have a deferred tax liability of 4,500. The interpretation of 4,500 is I am going to actually have a future taxable profit of 15,000 on which I will have to pay 4,500 taxes, which I'm actually accruing for today itself. I'm accruing for today itself. All right. So that is the reason I'm actually having a liability in my books of 4,500 rupees. Coming to year four, my temporary difference has now gone up to 20,000. My temporary difference has actually gone up to 20,000, which means that at the end of year four, I believe that in the next year, I am going to have taxable income of 20,000. But against that, not going to have any further depreciation because the asset is already allowed a full depreciation. The asset is already allowed a full depreciation over the 4 year period. So in the future years, at the end of year four, I'm saying there is going to be no further depreciation reduction in future. Therefore, my temporary difference is going to be equal to 20,000. This 20,000 represents my net taxable profit in future. So this is also going to be a taxable temporary difference. This is also going to be a taxable temporary difference, which means that my deferred tax liability is going to be 6,000 rupees. My deferred tax liability is going to be 6,000 rupees. So therefore over here also, if you'll notice, I already have a liability of 4,500. I want to increase it to 6,000, which means I want to again increase it by 1,500. All right. So again, I have a deferred tax expense account debit to deferred tax liability of 1,500. So as at the end of year four, my balance sheet is actually showing a deferred tax liability of 6,000 rupees. My balance sheet is showing a deferred tax liability of 6,000 rupees. Now, you might actually keep getting frustrated, right? Deferred tax liability is increasing by 1,500 every year, year after year, it's actually increasing. If you remember in the interest receivable example that we did right at the beginning, the first example that we did was of interest receivable. We saw that deferred tax liability is created in year one and is reversed in year two. It's created in year one and is reversed in year two. But over here, we are actually continuously increasing the deferred tax liability by 1,500 every year. When is it going to get reversed? It will get reversed in year 5. Let's actually see year 5. At the end of year 5, carrying amount is 0, tax base is 0, which means my temporary difference is also equal to 0. Therefore, I do not have any nature. It's ideally not applicable. If my temporary difference is 0, obviously there's going to be no nature as well. I am going to now have a DTA detail of 0. I'm supposed to have a DTA detail of 0. All right, because at the end of year 5, I am saying that there is going to be 0 future taxable profit and 0 future deduction. So in future, I do not have to pay any taxes, and therefore my DTA detail is actually equal to 0. But if you notice now, I in my books of accounts have a deferred tax liability recognized of 6,000 rupees. I have already recognized the deferred tax liability of 6,000 rupees in my books of accounts, which now I actually reverse out. I am now going to reverse out 6,000 rupees in my books of accounts in the fifth year. All right. So I'm actually just plotting this as negative 6,000, trying to represent that this is a benefit. All right. The signage I should have kept it the vice versa. Maybe let me actually do it that way. For all the previous years, I'm actually calling this as a negative number because it's a deferred tax expense. All right. I'm calling this as a negative number because it was a deferred tax expense. For the last year, it's going to be a deferred tax benefit because I have a liability in my books of accounts, which now I am actually reversing. Reversing a liability basically means that I will debit my liability and I credit deferred tax income or deferred tax benefit. Therefore, this is going to be an income for me in the last year. All right, so 6,000 is an income for me in the last year. So just like how we saw that 30 rupees of DTL in year one was getting reversed in year two, in the interest receivable example, we created a 30 of DTL in year one and we reversed it out in year two. But over here, in this case, the asset, in this case, this plant and machinery or this asset required us to recognize a deferred tax expense of 1,500 every year, and it resulted in a reversal in one year, which is the last year, where I reverse out the entire deferred tax liability. The journal entry for this will be deferred tax liability debit to deferred tax expense or to deferred tax benefit of 6,000 rupees. So at the end of fifth year, my DTL on the balance sheet will actually be equal to zero. All right. This row basically represents the amount of DTA or DTL that I will finally be having in my balance sheet. Step number four represents the DTA or DTL that I will finally have on my balance sheet. Step number five is the deferred tax expense or benefit that I'm supposed to recognize in that year. This is basically the P&L item. This is basically the balance sheet value, and this is basically the P&L item. The change in your balance sheet value is basically the amount that will be recognized in your P&L. All right. This is how we are actually going to calculate deferred tax asset and deferred tax liability for each year for the 5 years we have in the question. All right. So with that, we are done with question number 4.